Question 1. An investor buys a $1,000 par bond with a 5% coupon at a price of 80. What is the current yield? Is it A, 4%, B, 8%, C, 5%, D, 6.25%? The correct answer is D. Current yield equals annual coupon income divided by market price. The annual coupon is $50, and the market price is $800, 80% of par, so $50/$800 equals 6.25%. Question 2. An investor buys one XYZ put with a 40 strike for a premium of 2. What is the break-even point at expiration? Is it A, $42, B, $40, C, $44, D, $38? The correct answer is D. For a long put, break-even equals the strike price minus the premium paid, 40 to 2 equals $38. The stock must fall below $38 for the put buyer to earn a net profit after recovering the premium. Question 3. Using the same spread, buy one XYZ 50 call for 5, sell one XYZ 60 call for 2, what is the maximum loss? Is it A, $1,000, B, $300, C, unlimited, D, $700? The correct answer is B. The maximum loss on a debit spread is the net premium paid. Here the net debit is 3 points, 5 to 2, or $300, which is lost if both calls expire worthless with the stock at or below 50. Question 4. When a bond is quoted at 98 foot, the price the investor pays, excluding accrued interest, on a $1,000 par bond is it A, $9,800, B, $98, C, $980, D, $1,098? The correct answer is C. Corporate bonds are quoted as a percentage of par, so a quote of 98 means 98% of $1,000 par, or $980. The investor would also pay any accrued interest since the last coupon date in a regular way purchase. Question 5. An investor buys one XYZ call with a 50 strike for a premium of 3. What is the break-even point at expiration? Is it A, $50, B, $56, C, $53, D, $47? The correct answer is C. For a long call, break-even equals the strike price plus the premium paid, 50 plus 3 equals $53. The stock must rise above $53 for the position to be profitable, because the buyer must recover the premium before earning a net gain. Question 6. A convertible bond has a par value of $1,000 and a conversion price of $40. How many shares of common stock will the holder receive upon conversion? Is it A, 25 shares, B, 40 shares, C, 4 shares, D, 250 shares? The correct answer is A. The conversion ratio equals par value divided by the conversion price, $1,000/$40 equals 25 shares. Each bond can be exchanged for 25 shares of the issuer's common stock. Question 7. A mutual fund share has a net asset value, NAV, of $19.05 and a maximum sales charge of 5%. What is the public offering price? Is it A, $20, B, $19.05, C, $20.05, D, $18.10? The correct answer is C. When the sales charge is a percentage of the POP equals NAV/1 sales charge rate equals $19.05/1 to 0.05 equals $19.05/0.95 equals $20.05. The sales charge is $1, which is 5% of the $20.05 offering price. Question 8. An investor buys 100 shares of XYZ at $48 and buys one XYZ 45 put for 2, a protective put. What is the maximum loss? Is it A, $500, B, $300, C, $4,800, D, $200? The correct answer is A. With a protective put, the maximum loss is the stock purchase price minus the put strike, plus the premium paid, times 100, open parenthesis 48 minus 45 plus 2 close parenthesis times 100 equals $500. Below the 45 strike, the put lets the investor sell at 45, capping the loss. Question 9. A customer buys $20,000 of marginable stock in a margin account. Under Regulation T at 50%, how much must the customer deposit? Is it A, $10,000, B, $5,000, C, $2,000, D, $20,000? The correct answer is A. The Regulation T initial requirement of 50% applies to the $20,000 purchase, so the customer must deposit $10,000. The broker-dealer may lend the remaining $10,000, which becomes the debit balance in the margin account. Question 10. An investor buys one XYZ 50 call for 5 and sells one XYZ 60 call for 2. What is the maximum gain on this spread? Is it A, $700, B, $300, C, unlimited, D, $1,000? The correct answer is A. This is a debit call spread with a net debit of 3 points, $5 paid minus $2 received. Maximum gain equals the difference in strikes minus the net debit, open parenthesis 60 minus 50 close parenthesis minus 3 is equal to 7 points, or $700, realized if the stock is at or above 60 at expiration. Question 11. An investor buys one XYZ call option with a strike price of 50 for a premium of 3. What is the maximum loss on this long call position? Is it A, $4,700, B, unlimited, C, $300, D, $5,000? The correct answer is C. The buyer of a call can lose no more than the premium paid. Here the premium is 3 points times the 100 share multiplier, or $300. If the stock stays at or below 50, the option expires worthless and the $300 premium is the entire loss. Question 12. An investor buys one XYZ put with a 40 strike for a premium of 2. What is the maximum gain on this long put? Is it A, $3,800, B, unlimited, C, $4,000, D, $200? The correct answer is A. A long put profits as the stock falls, but the stock can fall no lower than 0. Maximum gain equals the strike minus the premium, times 100, open parenthesis 40 minus 2 close parenthesis times 100 equals $3,800, achieved if the stock goes to 0 and the holder buys at market and exercises the put to sell at 40. Question 13. Using a conversion ratio of 25 shares per bond, at what common stock price is a convertible bond trading at parity with a bond market price of $1,050? Is it A, $25, B, $42, C, $40, D, $26.25? The correct answer is B. Parity price of the stock equals the bond's market price divided by the conversion ratio, $1,050/25 equals $42. If the stock trades above $42, converting and selling shares would be worth more than the bond's current market price. Question 14. An investor buys one XYZ 50 call for 4 and one XYZ 50 put for 3, a long straddle. What are the two break-even points? Is it A, $57 and $43, B, $54 and $46, C. $50 and $50. D. $61 and $39. The correct answer is A. For a long straddle, the total premium is 7 points, 4 plus 3. The upside break-even is the strike plus total premium, 50 plus 7 is equal to 57, and the downside break-even is the strike minus total premium, 50 minus 7 is equal to 43. The stock must move outside 43 to 57 for a net profit. Question 15. An investor writes 1XYZ30 put for a premium of 2. What is the maximum possible loss? Is it A. $200? B. $2,800? C. Unlimited? D. $3,000? The correct answer is B. The worst case for a short put is the stock falling to zero. The writer must buy at 30 while the shares are worthless. Losing 30 points offset by the 2-point premium equals 28 points equals $2,800. Trap, unlimited loss applies to a naked short call, not a short put, because a stock's price cannot fall below zero. Question 16. An investor in the 32% federal tax bracket is comparing a 4% municipal bond with a taxable corporate bond. What taxable equivalent yield must the corporate bond offer to match the municipal? Is it A. 4%? B. 2.72%? C. 5.28%? D. 5.88%? The correct answer is D. Taxable equivalent yield equals the municipal yield divided by 1 minus the tax rate 4% / 1 to 0.32 equals 4% / 0.68 equals 5.88%. A taxable bond must yield about 5.88% to give the same after-tax return as the 4% municipal. Question 17. A taxable corporate bond yields 6%. For an investor in the 24% federal tax bracket, the approximate after-tax yield is it A. 4.56%? B. 7.89%? C. 6%? D. 1.44%? The correct answer is A. After-tax yield equals taxable yield x, 1 tax rate, equals 6% x, 1 to 0.24, equals 6% x 0.76 equals 4.56%. This is compared with a municipal yield to see which is better after taxes. Trap, 7.89% is the taxable equivalent yield of a 6% muni, 6% / 0.76. The reverse computation, 1.44% is just the tax portion. Question 18. A U.S. Treasury note quoted at 99.16 is priced at, is it A. $99.16 per $1,000 of par? B. $991.60 per $1,000 of par? C. $1,016 per $1,000 of par? D. $995 per $1,000 of par? The correct answer is D. Treasury notes and bonds are quoted in 32 NDS, so 99.16 means 99 and 16 / 32 equals 99.5% of par equals $995 per $1,000. Trap, reading the .16 as hundredths, choice B, gives $991.60, but treasuries use 32 NDS, not the decimal percentage of par convention used for corporate bond dollar quotes. Question 19. When a company pays a cash dividend, on the ex-dividend date the opening stock price is typically, is it A. unchanged? B. reduced by the amount of the dividend? C. increased by the amount of the dividend? D. doubled? The correct answer is B. On the ex-dividend date the stock's opening price is generally reduced by the dividend amount because new buyers will not receive that dividend. This adjustment keeps the market value consistent for buyers before and after the dividend right is removed. Question 20. An investor writes, sells, 1 uncovered XYZ call with a 50 strike for a premium of 3. The maximum potential loss is Is it A, limited to $4,700? B, limited to $300? C, unlimited? D, limited to $5,000? The correct answer is C. An uncovered, naked, call writer faces theoretically unlimited loss because there is no ceiling on how high the underlying stock can rise, and the writer must deliver shares at the strike no matter the market price. The premium received only partially offsets this exposure. Question 21. A pattern day trader is generally required to maintain minimum equity in a margin account of at least, is it A, $25,000? B, $10,000? C, $2,000? D, $100,000? The correct answer is A. FINRA rules require an account designated as a pattern day trading account, 4 or more day trades within 5 business days meeting the threshold, to maintain minimum equity of at least $25,000. This amount must be in the account before day trading may continue and provides an added cushion for the frequent intraday activity. Question 22. An investor owns 100 shares of a company that declares a 2-for-1 forward stock split. After the split, the investor will own, is it A, 200 shares at half the pre-split price? B, 200 shares at the same pre-split price? C, 100 shares at the same price? D, 50 shares at twice the pre-split price? The correct answer is A. A 2-for-1 forward split doubles the number of shares while having the per share price, leaving total market value unchanged. The investor now holds 200 shares, each worth half of the prior price. Question 23. Under anti-money laundering (AML) rules, a currency transaction report (CTR) must generally be filed for cash transactions exceeding, is it A, $1,000? B, $50,000? C, $10,000 in a single business day? D, $100,000? The correct answer is C. Under the Bank Secrecy Act, financial institutions must file a currency transaction report for cash transactions exceeding $10,000 in a single business day, aggregating multiple related transactions. Structuring transactions to evade this reporting threshold is itself illegal. Question 24. A market order to buy is an instruction to, is it A, buy at the closing price only? B, buy only at a specified price or lower? C, buy immediately at the best available current price? D, buy only when the stock trades through a stop price? The correct answer is C. A market order is executed promptly at the best available price when it reaches the market, prioritizing speed of execution over price. It provides no price protection, so in fast-moving or thin markets the execution price may differ from the last quote. Question 25. A mutual fund has total assets of $100 million, total liabilities of $2 million, and 4 million shares outstanding. Its net asset value, NAV, per share is it A, $25? B, $24? C, $24.50? D, $25.50? The correct answer is C. NAV per share equals total assets total liabilities / shares outstanding equals $100 million to $2 million. /4M equals $98 million /4M equals $24.50. Trap, $25, choice A, forgets to subtract the $2 million in liabilities. NAV is calculated at least once daily and mutual fund orders are priced forward at the next computed NAV. Question 26. An investor buys 100 shares of XYZ at $48 and sells one XYZ50 call for a premium of 2, a covered call. What is the maximum gain? Is it A, unlimited? B, $200? C, $400? D, $4,800? The correct answer is C. If the stock is called away at the 50 strike, the gain equals the stock appreciation plus the premium, open parenthesis 50 minus 48 close parenthesis plus 2 is equal to 4 points equals $400. Breakeven is 48 minus 2 is equal to 46. The written call caps upside at $400 no matter how high the stock climbs. Unlimited, choice A, would apply to owning stock alone, not to a covered call. Question 27. An investor who owns 100 shares of a stock and is worried about a near-term decline could best protect the position by, is it A, selling a covered call? B, buying a protective put? C, writing a naked put? D, selling the stock short? The correct answer is B, buying a put while holding the stock. A protective put creates a floor. No matter how far the stock falls, the holder can sell at the put's strike. The cost is the premium paid, which acts like insurance and reduces the position's net return if the stock rises. Question 28. An investor sells one XYZ30 put for a premium of 2. What is the maximum gain and the break-even point? Is it A, maximum gain unlimited, break-even $32? B, maximum gain $200, break-even $28? C, maximum gain $2,800, break-even $28? D, maximum gain $200, break-even $32? The correct answer is B. A short, written, put's maximum gain is the premium received, $200, kept if the stock stays at or above the 30 strike. Break-even is the strike minus the premium, 30 to 2 equals $28, and the maximum loss occurs if the stock falls towards 0. Question 29. The primary market is where, is it A, options are exercised? B, investors trade previously issued securities among themselves? C, issuers sell new securities to investors and raise capital? D, only government bonds are traded? The correct answer is C. The primary market is where new securities are issued and sold by the issuer, with proceeds going to the company through an underwriting. Once issued, those securities trade among investors in the secondary market, where the issuer is no longer a party to the transactions. Question 30. An investor owns 100 shares of XYZ and sells one XYZ call against the position. This strategy is known as, is it A, covered call? B, a protective put? C, a long straddle? D, a naked call? The correct answer is A, selling a call against stock already owned is a covered call. It generates premium income and provides limited downside cushion, but it caps the upside because the shares may be called away if the stock rises above the strike. Because the writer owns the underlying shares, the call is covered rather than naked. Question 31. An investor establishes a short straddle by selling one XYZ50 call for 3 and selling one XYZ50 put for 2. The maximum gain is it A, $300? B, unlimited? C, $500 if the stock closes exactly at 50 at expiration? D, $5,000? The correct answer is C. A short straddle's maximum gain is the total premium received, 3 plus 2 is equal to 5 points, or $500, achieved if the stock closes exactly at the 50 strike so that both options expire worthless. The seller profits from low volatility but faces large losses on a big move in either direction. Question 32. FINRA's minimum maintenance margin requirement for a long stock position is it A, 10% of the current market value? B, 5% of the current market value? C, 25% of the current market value? D, 50% of the current market value? The correct answer is C. FINRA rules require that equity in a long margin account be maintained at no less than 25% of the current market value of the securities. If the account's equity falls below this maintenance level, the firm issues a maintenance, house or FINRA, margin call for additional funds. Question 33. An all or none, AON, order instructs that, is it A, the entire order must be filled, though not necessarily immediately or in one transaction. B. Partial fills are always acceptable. C. The order executes only at the close. D. The order must be filled immediately or cancelled. The correct answer is A. An all or none order requires that the full quantity be executed, but unlike fill or kill, it does not demand immediate execution and can be worked over time. If the full size cannot ultimately be filled, none of it is executed. Question 34. A customer places a limit order to buy 100 shares at $25. This order, is it A, will be executed only at $25 or higher? B. Guarantees immediate execution at the market. C. Will be executed only at $25 or lower. D. Becomes a market order once the stock reaches $25? The correct answer is C. A buy limit order sets the maximum price the buyer is willing to pay, so it executes only at the limit price or lower. It provides price protection but no guarantee of execution. If the stock never trades at or below the limit, the order goes unfilled. Question 35. A buy-stop order is typically used by, is it A, an investor protecting a short position or seeking to buy on upside momentum? B, a dividend-focused investor. C, a bond issuer. D, an income investor seeking to buy the stock at a specified price below the current market? The correct answer is A. A buy stop is placed above the current market and triggers when the stock rises to or through the stop price. Short sellers use buy stops to limit losses if the stock rises, and momentum buyers use them to enter once a resistance level is broken. Question 36. The four phases of the business cycle, in typical order, are, is it A, trough, contraction, peak, expansion? B, inflation, deflation, stagflation, recovery? C, bull, bear, correction, rally? D, expansion, peak, contraction, trough? The correct answer is D. The business cycle moves through expansion, growth, a peak, contraction/recession, decline, and a trough, bottom, then repeats. A recession is commonly defined as 2 consecutive quarters of declining real GDP. Choices B and C mix in unrelated price level or market sentiment terms. Question 37. Which of the following bonds is generally most sensitive to a given change in interest rates? Is it A, high coupon bond maturing in 2 years? B, a long-term, low-coupon, or zero-coupon, bond? C, a short-term, high-coupon bond? D, a bond maturing in 90 days? The correct answer is B, interest rate, price, sensitivity, measured by duration, increases with longer maturities and lower coupons. A long-term, low or zero-coupon bond has the highest duration and therefore experiences the largest price swing for a given change in market rates. Question 38. Under Regulation T, the initial margin requirement for a purchase of marginable common stock is currently, is it A, 25% of the purchase price? B, 50% of the purchase price? C, 100% of the purchase price? D, 10% of the purchase price? The correct answer is B, Regulation T, set by the Federal Reserve Board under the Securities Exchange Act of 1934, currently requires an initial margin deposit of 50% of the purchase price for marginable equity securities. The remaining amount may be borrowed from the broker-dealer through the margin account. Question 39. A stock trading X rights means the stock, is it A, trades without the value of the subscription rights, which now trade separately? B, still includes the full value of the subscription rights within its current quoted price? C, cannot be sold? D, has been delisted? The correct answer is A. When a stock trades X rights, buyers no longer receive the subscription rights associated with a rights offering, and those rights trade separately in the market. The stock price typically adjusts downward to reflect the removed value of the rights. Question 40. The public offering price, POP, of a mutual fund share with a front-end sales load is calculated as, is it A, net asset value minus the sales charge? B, a fixed price set by FINRA? C, net asset value plus the sales charge? D, the market price set by exchange trading? The correct answer is C. For a front-end load fund, the public offering price equals the net asset value per share plus the sales charge. Investors buy at the pop and, absent a load, redeem at NAV. Closed-end funds, by contrast, trade at market prices that may be above or below NAV.